Good afternoon. It's our 3 p.m. Today we are covering 8 provisions inside of OBBBA, OBBA, that new One Big Beautiful Bill Act. That one become reality on July 4th. So there are 8 things inside of the act related to restaurants. So we're going to focus on just for the restaurant folks. If you run a restaurant, you definitely want to be here. And if you're thinking of starting up a restaurant, you for sure need to be here. And if you are exiting from the restaurant business, you still want to be here because you want to know what you can do, when you're exiting the restaurant. Now, there are 8 items right in here. So quickly, I want to cover it for you so you know what we're going to talk about. We're going to talk about qualified business income deduction, number 1. Number 2, bonus depreciation. Number 3, 179 section deduction. Number 4, business interest deduction. 5, meal deduction. 6, tips tax and overtime tax exemption. Then number 7, the 1099 new rule. And the last but not the least is the immigration raid that's going on right now. So let's get going, folks. So we have these 8 to cover. Before we talk about the content, we want to make you aware of our communitycpa.com website. This is our website. You can actually go to internet, communitycpa.com. You'll find us. And right on here, you will have a place which is called On Board with Us. You can become our client without speaking to us. You can just go on, upload, and talk on the email. So everything can be done, at your easy time, at your convenient time. Then, of course, you can make appointment with us. And if you are a client, you have your portal here. And the yellow button on the top is just where you will come in to pay our bills and reward us for the good work we did for you. And, of course, our firm, we are medium-sized regional CPA firm. We started from Des Moines, Iowa, so that's home. So that is home of Community CPA. So I want you to know the other branches are all expanded out of the best place, Des Moines, Iowa. I still say, our kids grow up here, and I have been here for, with my lifetime, I say Des Moines, Iowa is the most time I spent as of now. So that is how important that place is. And we have 6 other branches, folks. And the YouTube channel is also where we deposit all of our talks after we taught, and you learned, and it is on YouTube channel, so you can go back to review. But one thing I do want to mention to everyone, as much as you can get so much information online, you listen to me and you listen to others. And I literally had a client came to me last night, spent, want to know, 4.5 hours of my time and clarifying things that they got from the internet. I want to say that I am happy they still come to ask because the internet fed them with such a unrealistic concept they got. Then I have to detangle their hours of research and bring them back to reality. So I say that internet do offer confusions, okay? So you want to make sure that whatever knowledge you got, and this is really the disclaimer comes in, you want to make sure you take responsibility of what you learn. Just like my client, okay? Went on internet, God knows for how long of time, then come to me. I literally, I almost want to say wasted 4.5 hours of my time. But if I do not waste this time with this client, we would lose this client because they got wrong information from the internet. So do you consider that a waste? No, I think it's a necessary education. I am proud of them because they understand responsibility. They understand that the disclaimer out there is not for nothing. It is for you to verify your knowledge with the service provider you have. Of course, I don't wish everybody come to me for 4.5 hours consultation, but you should go to your planners, go to your accountant, go to your attorneys, go to your brother-in-laws, and get that knowledge verified before you really use it, right? So that is kind of where I'm lending my point. And this is the 2 books I wrote. You can have them on internet if you like to have them. And this is the YouTube channel I was just mentioning to you about. And make sure you listen to our YouTube channel, verify it, then use it properly. Okay, now let's get going. Number 1, qualified business income deduction. This is not new. You already have it. You already enjoyed it, restaurant owners. You know what I'm talking about. So if you don't know you have enjoyed it, that's just because when you were signing up your taxes, you did not ask that question. So now, tax season is about to be over for 2024. If you extended your tax return up to this point, and you want to look at your tax return, ask questions. I know qualified business income may not really be there. If your restaurant is a pass-through entity, you already probably filed in back on September 15. So October 15 due date is more for your personal. So you may not really, whatever you have, you may not really be able to change it anymore, but you will witness that on your 1040. So you had it before, you have it now, and then making sure that you ask that question if you don't know you had it or not. So this is 20% of reduction to your income. It is not 20% of your tax refund. So let's say your total income is $100,000. So 20% reduction means that instead of putting $100,000 as taxable income, you only need to put in $80,000 because there's a 20% deduction. So this is what it's all about the qualified business income. This one big, beautiful bill made it permanent. So it's not going away anymore after 2025. So it will be here. This is number 1 we want you to know. And the good things didn't go away. So we are lucky in that way as a restaurant owner, right? So here I talked about why the QBI provision matters for the restaurant, because the majority of the restaurant owners are using pass-through entities. So the OBBBA ensures that the 20% deduction will be here for you permanently. That way, the smaller restaurants, when you report your restaurant income under Schedule C as a sole proprietor, or as a partnership, or as corporation, then you enjoy this QBI as what it says here. All right, that's our number 1. See, that related to you, right? So our number 2 is 100% bonus depreciation. The new law set it permanent for saying that if you're doing qualified business asset purchase, then you are actually able to deduct all of your expenses outright. You don't have to depreciate that by so many years. You can just take it in, write it off. For example, if you're about to set up a restaurant and to renovate the place and with your grease trap and everything, it's gonna cost you $250,000 to get that place set up and going. That $250,000 leasehold improvement expenses is 100% written off. You don't have to depreciate your renovation based on the lease term. That's a lot of times is going that way in the olden days. But now this 100% bonus depreciation become permanent. You remember this one comes in back in 2020, right? This is the President Trump's term 1.0 that he pushed through that Job Act. That is what brought to here. But of course, 2025 is supposed to be like only 40%. Now it's become 100%. So just know that it only qualifies for the purchase that you actually did after his inauguration date. So it's not like January the 1st. So it has a weird starting date. And no dollar amount difference. So, folks may say that, well, what's so good about bonus depreciation? Bonus depreciation can let you have a loss on your income statement. So you could get refund back on your 1040 because your bonus depreciation. But Section 179, which is the third one we're talking about, that do not allow you to have a loss. So bonus depreciation would be the first one you choose if you want to write off your investment. So here is a scenario. A restaurant buys a new equipment of $20,000 in March 2025 under the old law. The bonus depreciation rate is only 40%. You can only just expense $8,000. But under the new one, so this one I'm talking about, the bonus depreciation rate is 100%. So you can write off the whole $20,000. So the company can immediately expense the $20,000. What does that mean? That means if your tax rate is 20%, you're here, instead of saving just $1,600, you actually would save the 20,000 times your tax rate. Say that's 20%, then that's a $4,000. So it's a big saving, right? So this is what I want to demo to you, so you kind of, make an impression in your mind that, okay, if I do anything like that, make sure it's a qualified asset, and then I can enjoy the bonus depreciation. So why the 100% bonus depreciation matters to a restaurant? And we talked about you bought the equipment, and those is passed through, right? The equipment. When I talk about the tax saving, it's not that your S corporation you're gonna save taxes there. No, I'm talking about it will create a loss for you, so you can bring that into 1040 and to really reduce your 1040 taxable income and getting more refund back from you. So now let's look at our number 3. Remember I mentioned a little earlier saying that Section 179. Section 179 also serves the same way, like you write them off. It has an upper limit, but most of our small restaurant owners, we don't even touch the upper limit, so we don't worry about that. But what I'm telling you is the big difference for our small restaurant owners between the bonus depreciation and the Section 179, it is about whether you can create a losses or not. So if you are already at a loss, but your loss dollar is a $1 loss, then you can no longer use Section 179 to reduce anything anymore. So you can use bonus depreciation to make your losses $1 become $100,000. So that way, and you bring it back to your 1040, reduces your W-2. Maybe your spouse is making a good salary, then you will see a good refund. So that is really the core difference between the Section 179 versus bonus in our small business owners world. I'm not talking about Elon Musk's taxes, not President Trump's tax, and I'm just talking about regular people like you and me, and you're running a small business. So that is the difference you need to remember. So why Section 179 expensing matters for the restaurant? So I already kind of mentioned to you that it matters to the restaurant because if you did have a loss after you expense your depreciation, then you want that depreciation to be labeled under bonus but not under 179. Okay, so the maximum hold on, the next slide. So the restaurant normally do not, like I mentioned earlier, the restaurant do not normally go over this threshold. Did you see that? The maximum amount got increased to $2.5 million. What they're talking about is that when you use 179, if your equipment is $2.5 million in the old way, and you only can take $1 million for 179, but now it increased to 2.5. It's really made for company much larger than the restaurants that most of our folks are in. All right. So that is about 179 expensing for the restaurant. And when you have a depreciable purchase that you know that you can take some advantage between 179 and the bonus, and you're not sure which way go is better, then I want you to talk to your tax preparer. And even if they don't know the theory, you have them plug into the treatment in their software, then they will guide you, goes, oh yeah, this one is better, that one may not be. Or they may even come up, say they're the same on the result of it, but at least give you guidance and you know how exactly to make a decision. So these two are all beneficial for the restaurant owners. You buy equipment, or you do a leasehold renovation, or you are building a building for your restaurant, or maybe you have a restaurant chain and you are building a processing place for the restaurant. If you are, just like those large restaurant chains, they have their headquarters packaging the raw materials for restaurant distribution. Those kind of facility is not considered retailing restaurant facility. They're considered production asset. Their production asset, then in OBBBA this time, it gives a new asset category, allow you to deduct the whole thing. So with that said, there's a lot of tax savings on a bigger operation. I want to say that if you felt so grateful about the OBBBA because it saves your taxes, and this tax saving is the bigger you are, the more you save. So that's kind of how it goes with this tax saving. But I want our small business owners, I know you don't have so much, but I still want you to understand the benefit and to try to make sure you don't let go any of the benefit that you could enjoy, right? Now, number 4, business interest deduction limitation. So this sometimes always surprise our folks, goes, what? What do you mean? I have a limitation? Yes, you have a limitation, because when you say, oh yeah, I paid $45,000 to a high interest lender, it's a loan shark, I paid a lot of interest expense. You know that all your interest expense may not be able to get deducted. You may not know because nobody told you, but now I'm telling you. So in the past, if you suspected yours was not deducted at all, and you can go back to look because there is a limitation. So this OBBBA restored a more generous definition of adjusted taxable income. This is the term that, if you can imagine that the tax calculation is a software thing, then this is a term, this is a formula inside of the software to determine, and I have this percentage, and 30% of this amount is what I can deduct on interest expense. So that amount, it is technically called adjusted taxable income. So, from the spirit of it, I just want to mention to you that it is basically this way. In the past, of course, the number is bigger, 30% will be bigger, it will be better for your interest expense deduction. But if the number is smaller, then the 30% is smaller, so you cannot deduct all your interest expense. So the new OBBBA made the number bigger. The reason they made it bigger, they actually allow you to put away of that depreciation. So let's look at this example. So a restaurant has $500K in net profit, right? And in net profit, of course, is already considered the depreciation deduction. So inside of that 500 profit, 200K in depreciation. So if we don't count depreciation, and there will be a bigger profit. So what I've said here is that their interest expense is 160K. So now, the old law says that it's a 30% times 300K, because it is using the 500K, the net profit, and it got rid of the 200K depreciation. So that came up with a new definition of the income. So the old one will be using 30% times 300,000. So the business owner can only deduct 90,000 interest expense instead of 160K, because they had 160K, they can only deduct 90. So this is particularly true for our folks who actually borrow from the loan sharks, or loan sharks is a negative term, but borrow from people who charge a lot. Okay, when you do that, you have a lot of interest expense. Then in this situation, you couldn't deduct 160K. You only deducted 90K. But the new law says that, don't worry about that 200K and just use the 500K. So now you got 150K, so you only have 10K you didn't deduct. Suddenly 30% times 500K, you got it all, almost all, right? So conclusion is the new rule allows more deduction, right? The new rules allows more deduction. So if you are a small business and you got relief over this, you can imagine the big business, they will get a lot of relief. So I am actually wondering who else going to pay taxes, after OBBBA. Obviously, we are just here to implement that to our small business owners, so we're not too worried about what Elon Musk is going to do, right? He needs to worry about himself. All right, so for our restaurant, how you have just one small restaurant, you really don't see a lot of benefit out of what we are just talking about. We talk about bonus depreciation, we talk about 179, now we talk about business interest, and it seems to be a little far from you because you are a small restaurant. But a lot of our clients, I wouldn't even say 1, 2, 3, quite a bit of our restaurants, when they run it individually for a while, and the next step for them to look at is to see how to duplicate their success. So from there, they began the journey of franchise. So when you get into this kind of operation, the loan, the business interest becoming your daily cup of tea. So this particular 163J, this is the code number, it would be important for you. So I want you to have a simple concept to know that when you have a business interest expense, they are not equivalent to your utility, to your cost of goods sold. They're not like that. They do go through this calculation to see whether you can deduct it or not, fully deduct it or not. So with that in mind, when you borrow money, you want to look at your profitability. You want to make sure that you actually can loan this kind of rate and you can even deduct it. Otherwise, what happened to you is your money is gone and you cannot reduce your taxes. So that is actually pretty regular to see those businesses that expanded out to the franchise then stuck with this particular issue. All right, now our number 5. Our number 5 is a meal deduction. So this meal deduction piece, I want to make sure you understand. Under this new OBBBA, restaurant can continue deduct the cost of meals provided to the employee without having to report these meals costs to the taxable income on their W-2. So you can continue, right? This provision preserves the long-standing treatment of what we call the de minimis fringe benefit, which include meals provided by employee. That convenience, it is the convenience for the employee. As long as the meal meet the IRS criteria, typically, number 1, provided on the business premises. Okay? And number 2, for the valid business reason. So in restaurant, you provide your chef with food that is that is qualified for IRS rules. Number 1, it is it is on premise. Number two is for the convenience of work. So with those reasons, you don't have to worry about the meal deduction. You can deduct it 100%. But, when we talk about meal deduction, it is really for business owners. You want to understand, as long as it is on premise, on your work location, as long as it's for the business convenience, for the employee convenience, and that way you deduct 100%. You don't add that meal amount to their W-2, right? But what if you take a potential client out to eat at the restaurant? That is still 50%. That is the same as before. So make sure you understand the difference between 100% and the 50%. All right. So our number 6 is no tax on tips and overtime deductions. So this is not exactly the restaurant owner's thing, but it is one of your things that you can maybe do two things with to be able to get employee a little easier, because in your industry, tips, they don't have to pay taxes. Overtime, they don't have to pay taxes. So that's number 1. So maybe easier for you going forward to retain the workforce. The number 2 side of easy for you is for the employee to be more willing to report to you about the cash tips they got in their pocket that you do not know. So why do I care about you knowing how much tips they got from the customer in their pocket? They just don't tell you. There's many reasons why you want to know. Because you are required to pay minimum wages to the employee. If you don't document the tips and you can't prove to the government that, and you actually meet minimum wages requirement, you cannot assume they got enough tips. You need to report the tips on the W-2. Now you know that when you say it, the employee will be less resistant, because even if you report it on the W-2, they don't pay taxes on it, anyway. So, of course, there's a threshold of $25,000, but, so far, I have not seen any employees at the restaurant making $25,000 a year on tips. Like, that's a pretty reasonable threshold. It's not low. Of course, overtime is has the same threshold. So those are all giving some incentives for your employee to work overtime for you, for your employee to report their tips to you, so you can do this right. Of course, this law came out on July 4th. So you already run your business from January to July. Then you're sitting here goes, I don't know what to do. It is not a complete number. We are not at the end of the year yet, business owners. So if you have a restaurant, if you have January to June, July, you don't know how to account for, now is time to figure that out for as accurate as you can, because it will benefit your employee. It is also will make your books and record more accurate. And trust me, your employee will be happy to know that they can report income and don't even pay taxes for it. And then they can turn around using their income level to maybe even do other things, qualify for loan and what. You just don't know what people do with their income level, and they can get benefit out there. And for having a strong income, they can rent a better apartment. And have a strong income, they can get a personal loan. Have a strong income, and they can brag about how well they do, so they can find a better spouse. I don't know. I'm just imagining it. But of course, a better income doesn't help people to get into welfare. You have to show you have a low income. But, that is going away anyway, right? So everything got cut. So there is no such a program anymore going forward. So why are you worried about that? We just want to make sure that you, as a business owner, report things properly and run your business clean and accurate. All right. So So I talk about that matters, and this is pretty much says the tip income is very relevant for restaurant staff, so they care. They want to be able to look at their income, think they made it. Who else don't want to feel they're successful? So your employee at the restaurant, they want to feel they're successful as well. Number seven, the new 1099 NEC reporting threshold. So this is the one that under the current law, which is going over at the end of this year, we're still under the current one, okay? So under the current law, the non-employee income reported on the information return 1099 NEC, and if it is over $600 in the period from January to December, you need to report. So that means, anybody who are more than 600, you want to report them. So you should prepare your 1099 EC. But beginning from next year, this new law increased the threshold from 600 to 2,000. So you can literally look at your 2025 1099 list, goes, oh yeah, I'm going to save so much time and money because I don't track them. I don't need to report 1099 on them anymore because most of my 1099 is under $1,000, right? So that would be a big saving for you. But it is not to say that you don't have a record. You should still have the record just for the proof that you are in compliance. You don't want IRS come around and goes, we know this person makes more than $2,000 from you because he reported on his tax that he got $2,000 from you, but you never send a 1099 NEC out. So still needed, right? Still needed to do it right. The requirement related to backup withholding, and it required when the payee fails to provide valid W-4 or W-9. You will simply be subjecting that person to withholding. And this is something that is coming up with the 1099 NEC as well. So this $2,000, it is also need to be aware of. If you got a $2,000 to this person and this person couldn't give you a valid ID, then you should withhold. So 2,000 should not be 2,000. You still report 2,000, but you're gonna withhold for the failure to provide your valid ID. So the restaurants with multiple locations and many payees and the contractors may benefit from this less reporting, right? Because if every of your restaurants is a separate legal entity, and obviously all of them going to be under this small amount, so you don't have reporting need. So no, in our firm, we have this service called Data Match. We actually can go onto the government system to download what government has reported on your particular ID. For example, if you are sole proprietor and you file your restaurant under Schedule C, then you probably use your social security number to do that. So under your social security number, we would be able to tell that what kind of 1099 it was issued to you, K, 1099K, 1099 NEC. So what we can do is that if you are the one getting 1099 NEC normally, but in year 2025, year 2026, you didn't get one because this rule is starting in 2026. Then you can actually check to make sure you didn't get one before you file your tax return. So that would give you a peace of mind, right? You know what government knows about you, and you file the tax return accurately to the federal and the state government. The last point, but not the least, is the increased ICE funding. So more immigration raids on restaurants. So this is something is also in the One Big Beautiful Bill Act to give 10 times more funding to ICE so that they can have the body, they can have the power, they can have the weapons to to raid the restaurant. So this is the target list that the IRS has. So not IRS, I mean the immigration. The White House has announced before. So this is agriculture. The targeted sectors for immigration raids are agriculture, construction, restaurant and hospitality, and manufacturing and childcare centers. So those are the list. So restaurant obviously is in it. So you want to be able to understand what's coming up and then put in measures to get yourself in compliance and it just, be aware that the business environment is changing. You can't just do it old way. If you are still on the old way and making every effort you can to do it right. So we here talking about preparation for raid and audit, compliance with employment law. It is so important. So we have 3 forms here we want to mention to you. So this is also part of the one big beautiful bill triggers you to do things that you were not so care about doing. So you need to get your I-9 all reviewed, situated. We actually provide, our firm, we provide payroll compliance review. So if you are running payrolls at your company on your own, you're doing it on ADP, but never heard of what you mean by compliance, we can come in to look at your I-9, tell you which one is not done right, and then look at your W-4 and making sure that you are following all the payroll-related compliance rules and regulations. So those are the things. Different time you speak different languages and we may not do anything like that and our webinar would never mention about these kind of things just because it wasn't really the priority at the time. But now is not the same as a year ago, so you do need to get your I-9 properly reviewed. Employers must ensure that all work authorization documents are valid and up to date. Yeah. And you cannot have people in your restaurant that don't have work authorization. Employers are responsible for verifying the authentication of these documents provided by your employees, such as Social Security numbers and tax identification numbers, passport, and a birth certificate. I know, I have people will say that, there's no way people knows the restaurant owners has all the knowledge about which passport is a fake one. I know that is a lot to ask, but what we are saying here is that is your responsibility. So if you are in good faith, looked at it and know it is right, and you hire the people, then that's not something would put you in jail. But if you know the person, it doesn't have documentation, then provide room and board, even support them to work in your business. There are people already in jail for that. They're called harboring illegal immigrants. So that's literally the charge of these people who are still in jail. So with that said, and I also don't know which jail they're in, but they're kind of secret. When they take people, you disappear from earth. So let's just make sure that you have that in place, done right. W-4, that is related to tax, how much you withhold, important. W-7 and the contract. This is when you hire 1099. Not only you need to have W-7 done, you also need to have a contract in place. So we want to make sure that the restaurants are prepared for those immigration raids. So what we are telling our folks is that you organize your employee record and you do an internal audit for yourself, please. So once you do that, you can pass on that and then you go on focus on your business. So response plan we had for our folks are developing a clear, clear procedures when you hire new ones and when people leave your workforce, and what document you make sure that you still save and keep, and where you keep your documentation in case immigration ICE came and surrounded your building. Typically I was told when they surrounded your building, then they actually know how many exits you have for your particular restaurant. So each of these exits, the ICE would have guard right around there. So, they're that's why they see a lot of ICE agents, because they deploy number of agents to each exit, so they make sure that everyone in the restaurant is captured. Then they will verify each one of those people's identity. If you are illegally in U.S., you are deported. And then if you are not illegally employed, but you don't have I-9 and W-4, you don't have your ID with you, then you'll be in detentions until you prove yourself with U.S. citizen or what. So these are the things that we want to tell the restaurant. It is not something anybody made up. And I know you already hear your friend, your other people, they already gone through the raid. So just for yourself, and you want to make sure that you prepare for that and get your payroll compliance in place. And now ICE get a lot of budget, so they will be here and for a long run. And the goal is to get rid of all these non-documented, no work permit kind of workforce. So the whole economic structures need to reshift. You, as a business owner, you just need to figure out how to do your business with the current condition, right? That is how people survive. That's how people start new business. And I always say that every movement in our reality, in our life, is actually will generate winners, will generate losers. It's just what it is. So you want to always position yourself, be flexible, and understand what is required, and just face it. I'm pretty sure with this tax deductions, all of these benefit inside of this one big beautiful bill, obviously benefit bigger company bigger, benefit small company smaller. But even though it is a small company smaller, to the small company is still pretty big. So with that said, just take a positive approach and make sure you are stingy with your tax dollars. Save every penny you can save. With that said, I come to my last slide. This is our partner. You can see right here, you can make a video business consultation call with us, and we will come online and to resolve your issues. My very last slide is just to tell you the ways to contact our firm. You can call us 515-288-3188. We operate 6 days a week. Yep, all year round. We don't have, we really don't have what we call tax season. Our season is all the same. It is always a warm season for us. It doesn't matter where we're located. And Catherine is our marketing manager, so if you email her, she'll make sure your voice is heard. If you want something in particular, want us to talk about, and you can email her and she will get me on and preparing for the presentation. Then I will see you right here at YouTube Live. So most of our live studio talk is under the tab of live. So if you look for anything that I did in the studio, and if you can't find on the home page, you go into YouTube and click on the live and you'll find us. I'll see you around, and